Well, I think in terms of the success of China, sort of two words, it's openness and privatization. If you look at the Chinese understand very well what Governor Sanford was saying about the world being flat. I feel sort of like last night all we heard was everyone was running for the mantle of Ronald Reagan. Today I feel we're all running for the mantle of Tom Friedman. But this was the most closed economy in the world 25 years ago. I was involved in I completed the WTO negotiation on China's accession to the WTO, and they made the most generous, they accepted the most draconian opening of their market of any country that's ever joined the WTO. This is a country that was the number 30 trading country in the world 25 years ago. It's now number 3, and it's going to be number 1 soon. Investment going into China 15 years ago, about 20% of all investment that went to Asia went to China. Now it's about 70%. The investment comes not only from people like Phil, but even more from overseas Chinese. That was the genius of Deng Xiaoping, to understand that there were these Chinese all around Asia and the rest of the world who wanted to put money back into China. And that's what's been driving Chinese growth, $60 billion a year in foreign investment, more than any country in the world. And privatization. 20 years ago, the contribution of private enterprise to China's total GDP was approximately somewhere between 0 and 1%. Now, private and foreign direct investments is responsible for over 60% of China's GDP. So, I mean, those are the two obvious open secrets of China's growth. But these are not without enormous downsides. The challenges you mentioned are just huge. The Chinese economy is massively unbalanced. There's too much investment. The investment rate of investment GDP ratio is something like 44%. That is orders of magnitude higher than the other Asian tigers were at their peak. And the result of that is that the investment is not rational. They have a financial services sector that does not rationally allocate capital. Interest rates are not an effective mechanism for determining allocation of capital. Basically, it's retained earnings by corporations. Particularly export-intensive, export-driven industries are the ones who are getting the capital, and they're continuing to grow. The savings to consumption ratio in China is the mirror image opposite of the U.S. Savings rate in China is between 40 and 50%. We're somewhere in the 0% range, give or take. Consumption, again, China has a shockingly low consumption rate. The reasons are obvious, because they have no social safety net. You have one child per family. You have basically no health care system or no social health care system, no social security system to speak of. When you get old, you're on your own.